All right, so what do we do about all of this? Individuals and businesses, we're really faced with a challenging tax planning situation. In as long as I've been practicing, the goal has always been, A, we want to reduce overall taxes. We want to find ways to reduce the total amount of taxes that we pay. And when we can't do that, we want to defer. We want to push it out and push it out and push it out and keep deferring it as long as we possibly can. We're facing a lot of tax increases, not just in the rates, but in these deductions and phase-outs and whatnot. And we're in a unique situation where instead of deferring, we are in many cases looking at accelerating. The difficulty is we really don't know. We don't know if next year is really going to have those higher rates. I think at the higher levels, we're pretty sure there's going to be some increase. But there's a lot of unknowns, so we're making decisions kind of in the dark. Potential things to do: sell long-term capital gain property. You have highly appreciated stock. You'd rather pay tax on it at 15% than at 20%. And if you're a high income taxpayer, that 20% has the 3.8 added onto it. We're at 24%. So if you'd rather pay tax on that gain today at 15% than sometime in the future at 24%, it's a decision that needs to be made. If it's something that can be held until death and gets a step up on death, maybe that's not the right thing to do. So every situation different, but something to consider. Consider Roth conversions. If it makes sense in your financial planning, this is probably the year to do it rather than waiting until the rates are higher. If you're under age 65, accelerate deductible medical expenses while we still have the 7.5% rate, or 7.5% floor. The first 7.5% of your adjusted gross income, you can't deduct your medical. Once you go above that, you can. And also stacking deductions, doing procedures at the beginning and end of the year instead of in 2 different years can make sense. So that's one consideration. Shift investments to avoid taxable income, looking at municipal bonds, although there has been talk of eliminating that benefit as well. So that's a questionable move. And accelerating the charitable giving. The talk about reducing the benefit of these deductions, these benefits for the rich, one of those is charitable deductions. If we have a cap on the amount of charitable deductions, you may not be able to take a deduction for those in the future. One way to get around that is to make significant gifts this year and to use something like a donor-advised fund, where you can make a large contribution in one year and you can make recommendations on how those funds are sprinkled out in future years. So continue to make those annual gifts, but get the tax break now while you can. Accelerate income and defer deductions. Pay down mortgage debts. This isn't really a tax planning for year end, but with the potential for the reduction of the benefit for mortgage interest, your cost for your mortgage goes up. So just another consideration. Potential year-end moves for businesses. This is a tough one. We have the opportunity to take large write-offs for expensing equipment either through the bonus depreciation or the Section 179, but at the same time we're facing higher rates moving forward. So it's our last chance to get those big write-offs, but we're taking those write-offs in a lower tax rate year than potentially a higher future year. So it's a tough decision on whether the time value of money overrides the increased tax there. I think in the case of longer term assets where we have the ability to do that, if we can take a 15-year asset and write it off in the current year, probably makes sense. If we're looking at a 5-year asset, we really need to balance it with the tax rates. If you're thinking of adding payroll, consider hiring somebody that qualifies under the Work Opportunity Tax Credit. That would be veterans. Sometimes it's difficult to target your hiring to certain classes of individuals, but to the extent that you have that opportunity, there's significant savings there. And potential additional changes here, acceleration of income, deferral of deductions. And really one thing to consider here is whether we're talking about long-term or short-term deferral. When we talk about accelerating income, it's really more accelerating income from 2013 into 2012 and deferring deductions from 2013 to 2012. Don't take this to mean that you shouldn't be deferring income into your retirement accounts where we have long-term deferrals and we really have no idea where the rates are going to be and what income levels may be in those future years. I think those long-term deferrals are still valuable and still should be used as much as they can. Structuring income to avoid the self-employment tax. Typically, this is going to need to be done at the business level. We've got some ideas on how to do that. And some groupings with passive activities to get around the 3.8% Medicare tax. If you have a C corporation that still has earnings in it, it may be the year to take dividends out or potentially even to liquidate C corporations and use that 15% rate before we move into the much, much higher rates that are coming. The required disclosure, every individual and business is different. These ideas are general and may or may not apply to your specific situation. So contact your tax advisor before taking any action with this. Thanks, everybody. I hope I didn't ruin your breakfast.